We start today with that hot inflation report and the impact on the markets as the markets try to figure out what the Fed will do and when. Here's what Atlanta Fed President Raphael Bostic told Sarah Eisen earlier on Money Movers.
My outlook is to start the normalization, start returning our product policies stance to a more neutral stance in the summertime. Right? And I'll have to say, a year ago, 6 months ago, I was in the fourth quarter. So we've seen tremendous progress, and I'm hopeful that that continues. If that continues, I'll be willing to pull it forward even further, but I want to see it continue before making that judgment.
You still think 3 rate cuts this year?
Well, that's what was in the dot plot. I was one of the 2 rate cut increases. Okay. So I'm still at 2. But if I pull it forward, if the data comes in more positively, I could move to 3 for sure.
All right, joining us now to talk markets, the Fed, inflation, Hugh Johnson, Chairman and Chief Economist with Hugh Johnson Economics. Also with us, Ron Insana, CNBC Senior Analyst and Commentator, also Chief Market Strategist at Dynasty Financial Partners. Ron, let me start with you. What do you, I mean, obviously the inflation numbers are a little hotter than expected, but coming down toward the target. I mean, they're lower than they were.
Well, I think the market's probably doing this, looking through the producer price report, 2.2% increase in outpatient hospital services is not exactly something the Fed controls from an inflation perspective. So I think some of the data, particularly for January, both for CPI and PPI, might be outliers. And it seems like certainly the stock market is more calm about it. Interest rates are up a little bit, but I don't think 1 month changes the assumption that we're going to see inflation continue to fall throughout the year.
Hugh, the markets seem to, apart from stumbling earlier in the week on that consumer price number, the markets seem to be motoring along quite nicely with interest rates right where they are. We heard an impassioned argument an hour or so ago from Mark Zandi that the Fed needs to move now, sooner rather than later, or it risks damaging the economy and hence the markets. Do you agree with that? Or why not just leave rates where they are if the desired effects are being felt? In other words, full employment is here or close, and low inflation is here or very close. Why change anything?
Well, Mark's got a pretty good point. He's got a pretty good point if you take a look at the numbers this week, particularly if you take a look at the retail sales and the production numbers this week. And what he's seeing, which I think a number of us are seeing, is that, look, we've kind of ruled out a hard landing. And I think it's a little bit early to dismiss that, particularly when you look at the numbers this week. And the second thing is a soft landing. That's very hard to rule out. And I think the consensus right now you'll find is that the expectation is we're going to see some pretty low numbers, first quarter, second quarter, third quarter, first and second for sure in 2024, down from those numbers like 4.9 and 3.3% that we saw in the fourth quarter. So Mark's got a good point. He's saying that the Fed's got to start to move now, or that the higher interest rates that we've been, quote, living with for quite some time now might have a more serious effect on the economy than most of us have in the consensus. It might be, I don't want to say a hard landing, but there is that possibility. You can't dismiss it.
Ron, meantime, obviously those hotter than expected CPI and PPI prints are out there, but we've gotten some disinflationary indications from the Q4 earnings number. Yeah. So, if you're an investor, how do you kind of square those two together? I know Q4 earnings are kind of backward looking, but as you assess guidance and various color from the calls and so forth, I mean, do you put more stock in that?
Yeah, I mean, to Hugh's point, I mean, we're seeing numbers that are softening up. And if you look at Atlanta Fed GDP now numbers, we've gone from 3.4 to 2.9 in the latest estimate. So we're starting to see things soften a little bit. Now, 2.9 is still a good growth rate, clearly. But yeah, the companies are in many instances, kind of not having as much confidence that growth will continue at the same pace that we saw in last year's economy. So, look, I'm still comfortable that this is going to be an abnormally normal year as far as the economy and markets go, barring any huge external shocks that we are not anticipating. And it just seems to me that we're kind of settling in. And I would agree with both Mark and Hugh. The Fed, they don't have to go in March, but, May would probably be a good time for them to start thinking about at least dialing back QT, if not starting to lower rates.